Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and today we're very lucky to be joined by Schroders Head of Private Assets, Claire Smith, for a secret to success in both public and private markets. Thanks so much for joining us today. We often hear in public markets, at least, that founder-led businesses are the cream of the crop. Is that the case in private markets?
Yeah, we think so. So 60 to 70% of our deal flow in the buyout part of the market is previously family-owned or founder-led businesses. And there's quite an interesting dynamic that creates a lot of alignment of interest. So typically when we enter one of these companies, we want the founder or the family to retain a 40% stake and we'll buy a 60% stake. Whenever we buy a company, we always underwrite to at least double our money. So if you think about that, and that's usually over a sort of 4 to 6 year time horizon, if you think about that, the family or the founder can actually make more money in that 4 to 6 year period than they did in the entire history of the business. So you get a lot of alignment of interest, you get access to companies that usually have a very good reputation in their particular market, but perhaps haven't had the capital or the knowledge to expand. And you get this really, as I said, really strong alignment of interest where everyone's highly focused on executing a business plan and then exiting the company over that sort of 4 to 6 year horizon.
What processes do you typically implement to improve those businesses?
Yeah, so there's usually some quite easy value creation levers in the business because they could have been around for decades and well regarded, but just not as efficiently run as possible, or they might have not had the capital or the experience to execute some plans. So what we find is it could be internationalisation, so going into surrounding geographies, they might not have had the capital or the knowledge how to do that previously, adding other products to their product suite or expanding vertically along the supply chain of the business. It could be as simple as adding a new C-suite, so effectively sort of transitioning the founder out and replacing them with experienced C-suite executives in that part of the market, putting in place a new board of directors, for example, effectively just really professionalising these companies and making them ready for that next phase of ownership.
Do you ever face any kind of conflict? I feel like founders are often really attached to their business. What are some of the problems that you face or that you've faced in the past when investing in founder-led or family-led businesses?
Yeah, that's definitely a key consideration. If the founder or the family aren't ready to step away and sort of relinquish the reins to a new investor, that can create a lot of conflict and can really impede those plans. So that's a huge part of our due diligence. And, we've got a 25-year track record of investing in private equity. So a big part of the due diligence is the founder or family ready to let go of the business, effectively making sure they're aligned, that they're going to help us execute on that value creation plan, be involved in the company for enough time, but then ready to transition out at the end. We find the entry and exit dynamics can help with that because we're often, when we're acquiring the company, because they retain a stake, it's not often around the most efficient price, it's around who's the best partner to grow their business. But then at exit, we do want it to be a competitive auction process when we sell the company. So I think getting them excited about that, getting them excited about the returns they could make and seeing their family legacy effectively move to that next phase.
Are there any examples that you could take us through of that, where you have taken a family business into that next phase?
Yeah, we have an interesting company in our portfolio at the moment, which is a UK pharmaceutical company. And they specialise in effectively taking drugs that have rolled off their patent period and then producing those drugs. So it's quite a revenue-heavy business, but quite technologically difficult. So that was a company founder-led. And what we've done, the main change there was starting to transition out the founder and put in a really experienced C-suite and a new board of directors. But additionally, we helped them expand into pan-Europe distribution. So previously just UK focused, and we've helped them sort of navigate all those regulatory and legal and language barriers into accessing the European market. But additionally, we've helped them add products. So they've added a rare disease drug to their suite, which is is really expanding in that pharmaceutical part of the market. So that's, a really interesting company where we're hoping to exit that later this year. We've taken it from what was a very well regarded, but really just UK focused, more narrow product, internationalised it, added drugs to their menu and added that really experienced C-suite, so ready for that next phase of ownership.
How long did that process take?
It's been in the portfolio for about 4 years now, so probably coming up to 5. So
quite a quick transformation then.
Yeah, that's the typical sort of hold period for these companies. We usually underwrite assuming it's going to take about 5 years to execute all those plans.
Speaking of exits, we obviously have seen quite a difficult M&A and IPO market over the last few years. What does that environment look like?
For our part of the market that we're involved in, often we're not buying through M&A processes. It's more bilateral approaching these families or founder-led businesses and effectively trying to encourage them to become privately owned. So we're not as reliant on the M&A market for investments, and then we're not really reliant on the IPO market for exits. So because our companies, whilst we buy in small and we can often help double the size, they're often still too small for IPO at that stage. So through a normal cycle, we'd only really exit about 10% of our portfolio via IPO. So the IPO market being shut hasn't affected us so much because we typically sell upmarket to a bigger private equity fund or to a corporate in that same space. And there is still a lot of dry powder at the larger end of the market. So a lot of the big funds have raised billions of dollars of capital. So that makes our exit dynamics quite favourable because they do have to invest that money, and some of them might even dip down into that sort of mid-cap part of the market to deploy some of that money. So we've actually had a couple of our most profitable exits over the last 12 months, and they've been not through IPO, but one was sales to a sovereign wealth fund, and the other was through sale to a bigger private equity fund. So there's still buyers out there for the high quality assets that we've invested in, and yeah, basically not reliant on that IPO market being open for those exits.
Well, thank you so much for your time today, Claire. It was awesome to feature you on The Pitch.
Thanks, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.